Well, hello, Brian. Very glad to have the opportunity to speak to you. I hope you're doing great, and yeah, good morning. How are you doing? I think you're muted.
There we go. You'd think we do enough of these in coronavirus, I would know that, but here I am. Thanks for having me.
Right, great. Well, yeah, it's been crazy time, and in this crazy time, exactly that's when the big things appear to be happening for the place where you work at. So it's extremely exciting to have the opportunity to talk to you about those developments and other visions that you have for fintech and crypto. And on that note, yeah, you've joined your current position just 4 months ago. How has it been? Was it just as you expected, or?
Well, I would say that nothing in the last 4 months has been just as any of us expected. You know, the way I tell the story is I was asked to do this job back around the holidays when we had 3.5% unemployment, relative social calm, and nothing but clear sailing ahead, which goes to show that you can never take the status quo for granted. It will always change. And it kind of reminds me of Mike Tyson's line about how everybody's got a plan until they get punched in the face. So I would say, no, it's not what I expected. On the other hand, the great news is that, you know, in America, we have a super strong innovation culture and risk tolerance culture in this country. And even things like pandemics don't throw innovators off their game, right? So I came into this job with a very clear vision of what the future was going to look like. Not that I wanted to make it, but I wanted to make sure that government didn't get in the way of the future. And suddenly we had to deal with these day-to-day exigencies of, hey, we've got an economic crisis on our hands. How do we hold the background economy together while we allow innovators to do what they do? So we've tried to do both of those things at the OCC to keep the banking system safe while also envisioning a 10-year out and 25-year out future that's going to look a lot different, and making sure we don't miss the opportunity to help construct a framework that lets all that happen in a safe and sound kind of a way. So crazy times. I know it's been for all of you and your viewers too, but I think we're going to get through this okay.
So yeah, obviously you've previously worked at crypto, being part of Coinbase, and now you moved into the role where you can actually make a considerable impact on the whole industry. Do you believe that the fintech and innovation that it brings essentially is, it's the future of what we are trying to build right now? And how long do you think it will take for that future to materialize?
Well, let me first of all say to your first point about you know, all the change and influence I can have in this job. I think the most important insight about this country is it's supposed to be markets and consumers that decide what the future looks like, not governments. Governments are there to make sure that people are protected from fraud, to make sure that, you know, violence is contained, to make sure that there's a set of rules in which we can all pursue our happiness. That's kind of what the Declaration says, right? And so my basic view is that companies that are building stuff, they're the ones who are creating the future. I happen to have had a vision of the future formed by 6 or 7 years in various fintech roles, including on the crypto side, but also in other tech innovation platforms. And my view is there are two big things going on that government needs to wrestle with and understand better. One of them, which I've written a lot about, is the concept of unbundling, which says that once upon a time, you know, before the internet, it made a lot of sense for finance to be bundled with all of the little pieces together. So you'd have your checking account at the same place where you had your mortgage, at the same place where you had your credit card. Consumer behavior has shown us that that may not be what people fully want anymore. You know, there are certain efficiencies to funding yourself with deposits that don't necessarily apply to other kinds of businesses. And that's why you now see payments firms and marketplace lenders out there not operating on a bank platform, and instead just operating on a standalone basis. And consumers and investors seem to like that for a whole bunch of reasons we could talk about. So that's one big trend line out there, which is pushing in the direction of fintechs being more important in the future than they have been in the past. And then there's the other big macro trend, which is decentralization. And that is the idea that you may need central authorities at a time when there's no good way of sort of connecting people peer-to-peer. But as soon as those technologies that allow that occur, you suddenly don't need the intermediaries the same way you used to. So I always give the analogy of the post office, where once upon a time, not that long ago, the only way you could send information from a person to another person is through the organizing principle of the post office. Everybody had to deliver all of their letters to one big central location. And that central location would sort everything out and then send it off to the people that you were trying to connect with. But then the internet came along, and now we have all kinds of direct peer-to-peer communication technologies that rely on networks. They don't rely on central authorities. That's a very apt analogy to what's been going on in finance over the last several years, and crypto in particular, where the notion is that once upon a time, if I didn't know you, I needed a bank to decide whether you were creditworthy and to administer the loan I might make to you and to decide the interest rate. But all of a sudden now, with networks of computers that are connecting blockchain nodes with each other, it's now actually possible to do some of those kinds of things without the need for that intermediary ledger keeper. And so the vision is that finance may one day look a lot like communication. It will go on a network, that central intermediaries may not be performing the same role then that they play today. And I don't advocate for that, but I also don't resist it. The point is those trend lines are probably unstoppable at some level. And we just need to put a framework around that that means that people don't get scammed in that future state any more than they get scammed today. That's really the main message.
Where do you think that sort of framework stands at now? Because we do still see a lot of bad behavior, essentially. I don't know, maybe in terms of like scale and where will we be able to get in, I don't know, 2, 3, 5 years from now?
Yeah, I mean, look, I don't either overweight or underweight the amount of bad behavior that we see in fintech businesses or in crypto. There's absolutely money laundering and criminal conduct and other things that go on in the world of crypto, and we need to do something about that, clearly and aggressively. But at the same time, believing that there's a future state where we can eliminate criminal activity or risk in other ways from any system is foolhardy. There are criminals among us, as it turns out. As a species, there are good people and bad people. And the bad people are going to exploit whatever system is out there. So there's a lot of money laundering that goes on in the banking system. You and your viewers will have just seen the headlines last week about the 2.5 million suspicious activity reports that got filed and then suddenly leaked in the public. All that shows you is in the banking system, there were 2.5 million instances where banks thought that criminal activity was going on. So, there's a little bit, I think, of status quo bias going on, where we think that the current system, the devil we know, is acceptable, and any change from the current system is risky. But the truth is, there's risks in the current system and risks in the future system. And what we need to do is weigh the cost and benefits of both, as opposed to just looking only on the cost and risk side of the ledger. We don't do that very well as a society, but I think that markets in the end are going to get what they want. And so I come back to the idea of, if there's bad activity in crypto, we need to get rid of it. We need to police it. We need to do what we do with banks, understanding that criminal activity in a human society will never go to zero. But we need to put a framework around it while letting people have the things that they want and need.
And in terms of, speaking of two systems, so the fintech and the traditional, do you think those will eventually merge or one will replace the other? And is this process going to be like sort of gradual and smooth, or is it's going to happen at one particular point abruptly?
Yeah, I think, change tends to happen slow, then fast. And we've seen that with a lot of things. There was kind of Internet 1.0, if you remember, which didn't seem all that revolutionary. I mean, I'm old enough to remember traveling the country as a lawyer with a big heavy laptop in my bag and an Ethernet cable and, even a 1.8 dial-up, cable. And the best I could do was connect to a very clunky email connection. And that's what Internet 1.0 looked like. And now we expect to be able to run our entire lives on the internet. I mean, we're doing this thing right now on an internet-enabled video conferencing service that to some people would be like the Jetsons. It's so futuristic. So in terms of, is it going to be fintech or crypto, if those two things really are somehow materially different, the answer is I don't know, and I don't want necessarily to put my thumb on the scale. So you could argue that fintech will reinforce the traditional banking model because most fintechs are basically doing banking things. They're just doing them better or faster or cheaper or whatever. So if you take the Plaids of the world or the Finicities of the world or whatever, they sit on top of banks. They make the data a little bit more accessible. They make it easier for people to shop around for loans, easier for banks to market loans, et cetera. That's all great. It tends to make the banking model better and thus reinforce it. Crypto has a little bit of a different philosophy, which is that one day we may not need banks as we think of them today. I believe there's still a core role for banks in that world. But my real point is, it's not up to me to sort of say what the model should be. Like, my job is not to protect incumbents. It's also not to advocate for insurgents. It's to make sure that I'm creating a system where markets can decide. The analogy I give is, if you look at the way that our equity markets work, the New York Stock Exchange brings finance both to General Motors and other old line car companies, and also to Tesla, a radically different challenger. It's hard to know whether Tesla, which is more expensive and harder to find fuel rechargers for and everything, will succeed because the luxury is amazing and the performance is incredible, or will General Motors succeed because it guzzles gas, but on the other hand is very easily accessible. Who can say? The reason we allow both to be brought before the market is because markets get to decide over time, and then people's choices will make those choices. And I think the same will be true with finance.
Right, and like, speaking of recent developments that came from your office, recently a letter was in the headlines that clarified the rules around how banks can custody crypto, and especially stablecoins. That was, in essence, a big development, even though it was just a clarification letter. But where do you see crypto in the federal banking system, and what's the next big step, in your opinion, should be?
Yeah, well, that's a great question. I mean, I would say, first of all, you might think that those letters, of which there were two, were modest steps, but I think they were in some ways really big steps, because the point was to say, hey, at the OCC, we're not advocates for crypto here, but nor are we opponents, right? The point is to say, hey, banks of the world, in any given market cycle, your customers are choosing to hold different kinds of assets. Like, in times of high volatility and inflation, people are going to be buying gold, right? In times of low volatility, people are going to be buying treasury bills. Some people will have stock certificates from the old days or whatever. And banks' role isn't to tell customers what to own. Banks' role is to intermediate and facilitate customers' ownership of financial assets, whatever those things may be over time. And so the point we made was, there are 40 or 50 million Americans who currently own crypto assets. That's not widely understood. I think your average person on the street believes crypto is super unusual and really niche-y, if you will. But that's really not so. And if the national banking system is going to play its role of providing a safe haven for people to store and transact value, then that has to include whatever financial assets people are holding at a given moment, and crypto is one of those. So, the custody piece recognizes that and tries to demystify it by saying, look, the market is speaking, these people want it, you banks have a role, go do the banking role. The stablecoin thing is a little bit different. So we came out with a letter talking about banks' authority to hold deposits that support fiat-backed stablecoins. Our view of that is a little bit different. It is that, hey, stablecoins represent a new form of payments instrument, right? So normally you have fiat dollars that are being transacted according to messages sent on various payment networks, like the SWIFT network or the automated clearinghouse system. Stablecoins, however, transact natively on a blockchain. Could be the Ethereum blockchain, the Algorand blockchain, whatever. Those things have different characteristics in terms of their user interface and user experience, even though the value of them is pegged to the dollar and is fully reserved. So our theory there is, over time, these blockchains really may just be payment networks. That might be the best analogy for what they are. And if that's the case, then we need to start providing some clarity to banks about the circumstances in which they can, A, support those projects, and B, at some point in the future, potentially use those blockchains as alternative payment systems to the status quo. We haven't spoken on that yet, and we're working, with our other agency partners to make sure that there's a clear and consistent message from the government on that. But those are questions that need to be answered, and I think we'll be looking at those in the future.
Regarding your first point about the crypto customers holding crypto, do you believe banks are reluctant to engage with those customers as things stand? And do you think this will change in the near future?
Well, I think that banks are reluctant to enter into any business that they regard as opaque from a regulatory perspective. So I think there's been an assumption that the government is generally hostile to crypto, just as a category. And again, it's because in some people's minds, crypto is held up as it's the alternative financial system, and alternatives are riskier than the status quo. That's the status quo bias I adverted to earlier. I think, in fact, I saw some survey today saying that something like 63% of bankers surveyed saw crypto as more a risk than an opportunity. But I think the reason for that is that the regulators have, A, not put a framework around it within which banks can safely operate it, and B, have said almost nothing about our view of the underlying assets and technology. I think regulators have been super clear that we're not in favor of money laundering, and that anybody in crypto has to have good Bank Secrecy Act controls to prevent crime and money laundering in particular. But that shouldn't mean that this is more dangerous than traditional banking. Traditional banking also has those risks and also has to adopt those controls. So what we're trying to do is just provide clarity. And my guess is that once we provide clarity, there are going to be some banks that see an opportunity here, and they will tend to specialize in those businesses. And other banks will say, look, that's not core to what we do, and we don't necessarily want to do that today, which is totally fine. But the point is the market can only develop organically if there's clarity, and that's, I think, what our role is in the system.
I also wanted to pick up on the second point you made about stablecoin payment systems being perhaps the future. Do you believe that a digital dollar, and the one backed by the US dollar coming from the government, is a competitor to the stablecoins right now? Will the extensive use of stablecoins really affect the dollar? And what is your stance on the digital dollar as it is?
Well, it's an interesting way you ask the question. Is the stablecoin a competitor with a government-backed digital currency? That's a little bit like asking if flying cars are a competitor to Tesla. I mean, they probably would be a competitor if they existed. People have been predicting flying cars 4 years out for the last 50 years, and somehow we never quite get to that place. So you should ask me that question again in 4, 5, 6 years when there is a Federal Reserve, digital dollar. But in the immediate future, there isn't such a thing and isn't gonna be such a thing. So I look at stablecoins as a thing that is currently transacting, and it's transacting at enormous volumes. In fact, you've probably seen over the last 4 or 5 months, the curve of stablecoin market capitalization has gone like that. It's really been quite amazing. These things have been doubling every 60 days for about the last 3 60-day periods. And so to me, what that tells us is that is the digital dollar. So when people talk about something that's backed by the government versus not backed by the government, the point of our stablecoin letter was to say, we don't want banks involved, at least not at the moment, not before we've done a lot more study, in stablecoin projects that are not fully reserved dollar for dollar or yen for yen or euro to euro. We don't want things like that because we don't want runs on the bank. But these things do exist. They do transact instantaneously across blockchain payment systems on a global basis, and are doing so today. So right now, I don't think it's an issue of competing. My personal view is the role of governments isn't to build tech. It's not to issue particular tokens in the same way that the government doesn't issue traveler's checks, right? American Express does. They don't issue prepaid cards. Citibank does. And there's a reason for that, right? The government is really, really good at establishing rules and conducting supervision. We're great at that. Government has no history at all of building products that innovate or that offer people good choices. And so why would we think that that would be different in constructing a payments instrument? I just don't think that's the right role. So we're trying to go out with frameworks. We're excited that there are tech companies coming out with tokens. Let's marry those two things up, our frameworks, their tokens, and then I think we can catch up to the rest of the world, which is way beyond us on this issue at the moment.
So are you saying that other countries are ahead of the US right now in terms of regulation?
Well, I mean, look, China issued an e-renminbi that is now circulating, and they issued it last week. Our government says that we're 4 years away at a minimum from issuing a test version of a US central bank digital currency. So I don't think that's a matter of opinion. Even going further than that, the EU put out a draft stablecoin framework document about 2 weeks ago. We're working on that right now with our other agency partners, and I think we'll speak to that relatively shortly. But still, the EU is out in front of us. We are supposed to be the global financial leader, or at least we have been for the last 50 years. And I want to make sure that we retain status even as other countries are looking to catch up. That requires that we move faster.
Sure. And talking about other things that are sort of big right now and changing things around is DeFi, obviously. Where do you stand on this whole concept that's emerging? Do you think it's a bubble, or it's the actual future, and that's how fintechs will work, and are they going to integrate those solutions that the DeFi companies are proposing?
Yeah, it's hard to know. I mean, I think DeFi is sort of the cutting edge of an already cutting edge area. But I'll say that we think it's important enough that we actually had the founder of one of the most important DeFi projects come in and brief the OCC Executive Committee on their project and on the kind of the use cases of DeFi just a few weeks ago. So we certainly take it seriously. I think that in the future, there are going to be, as there are in everything, they're going to be early adopters and late adopters. My guess is I will be a late adopter of DeFi personally, but it's a very interesting use case where the idea is you can buy tokens and contribute them onto a network, and then the network algorithms will determine, based on other activity on the network, how much, I'll use the word interest, but how much return you want to receive on that investment and what other things you can do with that. The idea of DeFi as, for example, replacing version 1 peer-to-peer lending platforms seems like something that's very probable, right? Especially because a lot of those things are not truly peer-to-peer. And so at the end of the day, I don't know when and whether they will replace our traditional system. But what I do know, my core thesis is networks are more resilient and faster than central points of failure. And so if that is the main thing DeFi is doing, which is replacing central authorities and human fallibility with algorithms that are inherently fair and that are optimizing for things that you disclose to your consumers, then I would say there's a future in this stuff. How that evolves remains to be seen.
Okay, moving on. I wanted to ask you about the national bank charters for the payment companies. I know there's been some issues along the way, we can talk about them later, but do you think those sort of the solution is necessary given what's already available and perhaps other systems that are being developed even by the US government like FedNow?
Yeah, well, I mean, I again, on US government FedNow, I think it will be great if that thing comes to pass. But again, I'm just going to remind your viewers, when the government promises you something 4 years out, what they're sort of saying is, we doubt any of you are going to remember that we said this, and so we'll just kind of see what happens in 4 years. That's a super long time horizon, and nobody who is a private sector product builder would say, hey, we're going to deliver you a cool new product in 4 years, right? Because if you can't deliver the product in 6 months, it probably means you're not going to deliver it at all, right? Remember the maxim of all fintech, and frankly all tech, which is if you're not embarrassed about your first version, you probably waited too long to release it. So I just, any question that begins with FedNow, that's sort of where I start. But on these charters, what we're really trying to say with the charters is a couple of things. One is a lot of activity that used to happen in the banking system and that customers used to have confidence was being supervised, right, is no longer happening in the banking system. So payments are probably the best example of this. Once upon a time, 10 years ago, 100% of payments processing activity happened in a handful of big banks. And you might love big banks or hate them, but what you know is my examiners are on site at those banks every day, pre-coronavirus, right? And so you could know that there was some cop on the beat, some watchdog who was paying attention, who was making sure that there was liquidity and capital rules so that those trades would settle, and making sure that there were customer disclosures so people understood the fee structure and the settlement time and everything else. Now that's happening on platforms that aren't supervised with the same rigor that we supervise them. And so I can't make any guarantees to the American people about what's going on there. To me, since those activities were always regarded as banking services, it's important that there be an option that those companies select a bank charter and customers can then have that confidence. Now you might ask, why would those companies want to subject themselves to that kind of regulation? Isn't their whole advantage that they opted for this lighter weight state charter platform? And I think the answer is twofold. One is, when you're state regulated, you have to be licensed in all the states. And it turns out that state laws on all kinds of things, whether they're maximum interest rates that a marketplace lender can charge, or whether there's specific customer disclosures or limitations on the kinds of people you can transact with or whatever, those rules vary from state to state in really fundamental ways, to such an extent that there are literally activities that are mandated in some states and prohibited in other states, right? The national bank charter alleviates that. It says that as long as you subject yourself to OCC supervision, you can operate across state lines without regard to state laws that would conflict with the exercise of your banking powers. So there's a real reason that these companies would want a national bank charter once they achieved a certain scale or had a certain business model. And the other reason why they might want this, of course, is there is a certain customer confidence and prestige that comes with the national bank charter, because historically it's been a lot harder to get. So if we charter a bank, it sends a signal to the market that this company is mature enough and has rigorous enough risk management and compliance protocols to survive our scrutiny. And so not every company can do that. And typically it takes years to build a platform that can do that. But once you've done it, don't you want to send a signal to your customers that that's how good you are? So I think for those reasons, yes, charter initiatives are really important. And that's why we're defending them.
Yeah, and you're defending them. Actually, what's the status of that situation? Because they've been blocked essentially by an authority, and what's the update?
Yeah, well, so they haven't been blocked. I mean, there's a district judge that entered a legal ruling that said that in his interpretation of the National Bank Act, we can't charter as banks something that doesn't take deposits. What I would tell you is, the judge declined to enter an injunction. And so he's entered a legal ruling against us, and that's on appeal in the Court of Appeals in New York. I expect that we will eventually win that case based on the fact that the OCC in the Supreme Court has always won these kinds of cases. And yet every single time over history that the OCC has endeavored to make a new pronouncement on bank powers, say something about the way that banks can adapt to current circumstances, those have always been challenged, often by the states, and the OCC is often lost in the lower courts. Lower court judges are humans like the rest of us, and they have opinions and sometimes make mistakes. I'm confident we're going to win that case. It would be a big deal if we wind up not winning that case, but it might take one or more levels of appeal before we finally do. That's okay. That's what we do. In terms of other things, though, I would just say there are, in fact, other charter types that are not legally under challenge right now that don't involve those issues. So, for example, we have a number of payments companies talking to us about national trust bank charters, which don't require insured deposits and yet are statutorily created, and there's no legal question about their viability. So, in my view, this is all fine. We're open for business. If and when somebody comes in to apply for a non-depository charter, we would consider it on the merits. And in the meantime, people are talking to us about trust bank charters and other things.
Okay, well, Brian, we've got about a minute left. I just want to ask you one last question about the overall nature of the crypto industry and the fact that it's decentralized. Does that present a problem for you in your current role or any other, regulators? Is a new approach needed to work with such firms that stick by those rules?
Yeah, look, it's a challenge. It's a new thing that we haven't looked at, but we need to figure this out in the same way that there are other things we need to figure out. How do we regulate artificial intelligence underwriting algorithms? It's artificial intelligence, so we can't unpack each data element, right? Because the machine is learning and changing with every new transaction. And yet, if we're going to get the benefit of these radical new technologies that will make credit more accessible, that will help those people who have not been included in the old system, we got to figure it out, right? And simply saying it's different, so we have to throw up our hands, as you can probably tell, that's not my style.
Very glad it's not. Well, thank you, Brian. I think we're out of time. Thank you very much.
Thanks so much, Alex. Pleasure to be here.